Losing a spouse is hard enough. Then tax season comes, and a lot of widows and widowers find out something nobody warned them about. With less income coming in, they somehow owe more money to the IRS. That's what's called the widow's penalty. And it's today's topic on the Howdy Neighbor Retirement Show.
It's the Howdy Neighbor Retirement Show.
Howdy neighbor, I'm Michael Andrews with Andrews Insurance and Advisory, and you are listening to the Howdy Neighbor Retirement Show, where we tackle real-life questions about retirement, Medicare, and Social Security every week. Today is another Michael tutorial, and we are talking about the widow's penalty, what it actually is, why it catches so many surviving spouses off guard, and what you can do about it before it happens. So a few episodes back, we covered some of retirement's biggest tax traps. Things like required minimum distributions, IRMAA, the Secure Act's 10-year rule, and the widow's penalty belongs right there on that list, and it deserves its own conversation because it is one of the most common, least talked about problems that I run into. So here's the setup of how it works. There's no line on a tax form that says widow's penalty. It's what happens when several tax rules collide at once the moment your filing status flips from married filing jointly to single. Again, I was reading another article on Kiplinger with the numbers. So for 2026, married filing jointly, your standard deduction is $32,200, and the 12% tax bracket runs all the way up to $100,800. File single, and the deduction is cut to $16,100 with the same 12% tax bracket capped at $50,400. Same income potentially, a lot less of it is protected. If something happened to your spouse tomorrow, do you know what your household's tax bill would look like the very next year? Filing as a single person on the same income. These are things that people just don't think about until it's already too late. So a lot of folks assume less income means a lower tax bill. Often it doesn't, because required minimum distributions from IRAs and 401ks do not stop. And now there is a smaller standard deduction to offset them. Even the new senior bonus deduction gets cut in half. So a $12,000 combined break as a couple now would cap at $6,000 as a single filer. There's another piece that catches people off guard, and that's Social Security. The survivor typically keeps the larger of the two checks, not both. So the check itself often goes down, but now you're filing single. And the income threshold for how much of Social Security gets taxed are a lot lower for single filers. A smaller check can still mean a bigger taxable share, sometimes up to 85%. So do you know which one of you has the larger Social Security benefit? That's the check that continues, and it's the one that your future tax bill gets built around. And then there's Medicare. IRMAA looks back 2 years at your tax return to set your Part B and Part D premium. Because single filers hit those thresholds at lower income, some surviving spouses get a higher Medicare bill the very year that their income drops. But there is relief. Something called Form SSA-44 lets you request a new IRMAA determination after a life-changing event like the death of a spouse. But you have to know who to ask to figure out what that window is. So let me put some of this into real numbers for you. So let's take a couple with $90,000 in combined retirement income, comfortably inside the married 12% tax bracket. The husband passes away. The wife income drops to $70,000, which is genuinely less money, but she's now filing single with half of the standard deduction, and a big chunk of that $70,000 gets pushed into the 22% tax bracket. Her tax bill can rise by $2,000 or $3,000 a year, plus you could add an IRMAA surcharge that she didn't see coming, and that's another $1,000 to $2,000 in Medicare premiums every year, simply because nothing was restructured before her filing status changed. Now, here's why timing matters so much. The year your spouse passes, you can usually still file jointly one last time. A window for a Roth conversion at the wider married bracket that closes once that year ends. That SSA-44 request for IRMAA relief has to be filed after the event with documentation inside a specific window. If you miss that, you pay the higher premium regardless. And decisions about which Social Security benefit to draw, plus account tilting and beneficiary designations, are far easier to get right while both of you are here to talk it through than to untangle afterward. None of this can be optimized a year later. That's what makes this different from most retirement planning. If your spouse had to handle the taxes and the accounts alone next year, would they know exactly what to do? That's a very important question for you guys to ask yourself. Would 20 minutes right now be worth it to find out where the gaps are before anyone needs the plan? I also want to be clear about one thing, and that is this is not about replacing your CPA or your existing investments. Most people I sit down with already have both, and we still turn up things nobody had connected. It's not a sales pitch dressed up as education, and you don't need all the answers walking in. It's a conversation, no obligation. No, we'll deal with it later is exactly the thinking that turns this into an expensive surprise instead of a plan. So today we talked about the widow's penalty and what it actually is. Not an official IRS penalty, but several tax rules all coming together at the wrong time when filing status changes from married to single. Income can fall while the tax bill rises. More of a Social Security check can become taxable even as the check shrinks, and Medicare premiums can climb from a 2-year look back in the very year income dropped. Most of all, the window to act sits before the loss and unfortunately not after. That's exactly why I built the Widow's Penalty Prevention Review. It's not a generic sounding opinion. It's a specific look at 5 things. Whether a final joint filing year Roth conversion makes sense, your projected bracket as a surviving spouse, how your Social Security claiming and survivor benefit strategy is coordinating, whether you're near an IRMAA threshold, and whether your beneficiary designations and account tilting actually match what you think they say. You leave knowing exactly where the gaps are while there's still time to close them. If you want to start even before that conversation, you can email me and I'll send you my widow's penalty checklist, 5 things every couple should have in place so you know exactly what to gather before we ever get on our call. If you've got a question that you'd like for me to tackle on the show, if you would, shoot me an email at michael@andrewsadv.com. I read every single one of them, and I just might answer yours on a future episode. You've worked hard to build your retirement, and neither of you should have to face this alone. If you want that Widow's Penalty Prevention Review, I'm here to help. It doesn't cost anything for me to take a look, but not letting me, it could cost you thousands. So if you're ready to take this to the next level, you can call or text me at 918-842-7379 or schedule a time on my calendar at andrewsadv.com. And wherever you're listening, whether that's the radio, YouTube, or Facebook, make sure you subscribe and follow the Howdy Neighbor Retirement Show. We don't want you to miss next week's episode. If this helped, give it a like, share it with a friend who could use some good neighborly retirement advice. Thanks again for listening, and we'll see you next week right here on the Howdy Neighbor Retirement Show. Thanks.
It's the Howdy Neighbor Retirement Show, helping you plan so your money will grow. No need to worry, we'll make it clear. Medicare